Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Hey, if you'd like to call today, the number is 216-901-0945. If you're new listening to this program for the first time, congratulations to all two of you. I'm just kidding. Well, maybe not. You don't know. But anyway, feel free to call with any questions you have regarding financial planning, investment planning. Investment planning is a big part of financial planning. And financial planning, you know what the number one most important item in financial planning is? It's actually living beneath your means, not within your means. You literally have to live beneath your means. Because, you know, back in the day when I first started in this industry, I'm embarrassed to say it was 30 years ago. Actually, 31 now. Oh, whoa. That just dawned on me. 31. That was my Pee Wee football jersey number. 31 years. That's unbelievable. Anyway, back then, you know, they taught that the long-term average of the stock market was right around 10%, you know, and bonds returned right around 5 or 6%. Well, going forward, they're saying stocks are probably going to average around 6%. Bonds are probably going to average around 3%. And it's a big difference. It's a huge difference, actually. And so what that means is, you know, before they said live within your means, save 7% of your income. Now they're going to say save 15% of your income because you're going to have to live beneath your means to be able to maintain that lifestyle into retirement. So that's all I have to say about that. Being Forrest Gump. Actually, Forrest is... Oh, never mind. But so if you have questions and financial planning, you know, really, in my mind, it's really about planning for financial independence, which a lot of people like to call retirement. You know, and they're going to become financially independent whether they like it or not at some point in time. But if you could plan to get there a little early, I don't think you should quit working, by the way. That's a bad idea. You quit working, and I'm telling you, your life expectancy just shortened by probably 5 to 10 years. That's just Bill Bullington's observation on the general public, because my average client's 74. That's hard to believe. But a lot of them have been with me for a very long time. And I'm much older now. So that's kind of how that thing works, you know. Old man time bats 1,000. So we're all getting older, and I can tell you throughout the last 31 years, what I've noticed is that people who retire and stop working completely have a tendency not to hang around that long. That's just an observation for whatever it's worth. So I would say, you know what I want to do in retirement? I want to work at Lowe's. I want to go into Lowe's. My dad was a remodeling contractor. And you know what? That we used to say you get sawdust in your blood. And that's pretty true. I would love those HGTV shows and all the shows on remodeling. I can't even remember all the names of them now. There's so many of them. There's a remodeler, a couple magazines that show all that stuff. And it does get inside your blood. But I would love to go to Lowe's and be able to work there and bore all the younger people by saying, oh, man, if I'd have had that in my day, or if my dad would have had that. And he used to tell me stories about his grandfather, who would spend a lot of time every day sharpening his saws. Okay, these were saws that you cut wood with by hand. And he really hated the new fangled electric saws, because he said, what are you going to do if the electricity goes out? And he was right. You know what they did? They went home. You couldn't do anything without tools. So anyway, Times change, and you're looking at that stuff. It's pretty cool. I really like the changes, by the way. I like the changes that have happened in the stock market. Changes over the past 5 to 6 years. The past 5 to 6 years came along at a time when I didn't expect it to, because I had expected it in 2004, and it was a long time in coming, but it finally came. What do I mean by that? What I mean is you have ways of investing now. They're called exchange-traded funds. They're basically mathematical algorithms, mathematical formulas run by computers that buy and sell stocks. Now, that's created some challenges. It's actually reduced the effectiveness of certain money management techniques, but it's also increased the ability to do others. And that part I really like. I really like a lot. I've got a couple of models that, if you want a copy, you actually have to call my office. We have to have a conversation. I'm not allowed to offer this out to the general public. But you can call me and you can say, hey, you're talking about that semiconductor model, and I'd like to know a little bit more about it, and we can have a 60-second conversation. I can say, oh, yeah, let me email that to you. So that's what we have to do. I have to have a small conversation about it first, then I can mail it out. I'm just not allowed to use it as mass mailing because that's considered advertising, and there are restrictions against that sort of thing. And being the fact that I'd like to stay in business, I think I'm going to follow that rule. So all you have to do is give us a call, and we'll talk about it. That's a big deal. There are lots of big deals now. Some of the funds that I've liked for a while have hung around long enough. That's another thing you learn by experience. You'll like a fund or an idea or a strategy, and you're the only one that likes it, or there aren't enough people that like it, and so they don't invest enough money in it, and they have to shut the fund down because they can't afford the operating costs. And that was very sad for a long time. So I got to the point where I would wait for a fund to be out for 3 or 4 years minimally, or get up to $500 million in assets as kind of a minimum. Because when you're only charging a fraction of a percent, you got to have hundreds of millions of dollars to keep that fund open and pay the bills. So it's been very interesting watching all this unfold. They're on very steady footing now. Every year, though, there are hundreds of funds that shut their doors because nobody understands what they're doing. And that was really frustrating for a long time. I'd get a fund. I knew what the concept was. I thought, oh, this is a great idea. This is something we should be doing. You get in the fund, and a year and a half later, they're shutting the fund down and sending your money back. That was not fun. I think that happened about 4 times. And so I started to wait. And now there are tons of funds that have been around at least 4 or 5 years that have at least $500,000 in assets that have really good ideas. They're excellent ideas. Not that you shouldn't foray into individual stocks, because I think they're fun. I think it should be relegated to a hobby, hobby portion. I've got, I don't know, probably more than I should. So for me, it's a big hobby. But I have most of my money in funds, and I've got a portfolio, a basket of stocks that I like. There are stocks that I like to watch that at some point in time I may end up purchasing. There are some that came up on my scans. I run the scans. You guys that have been listening for a long time remember about buying breakouts and what that actually means, what that does. Well, I've been watching just recently, and there are lots of them that are coming up on my screens. What that means is the market is looking much healthier. When you don't have a lot of stocks that are meeting the criteria that come up on some of my scans, that's not a healthy market. And right now you've got, wow, this is amazing. There's a large number. It's like 2 out of 3 stocks. That's the strongest number I've seen. I just looked at that. It's the strongest it's been in a few months. So that's a good sign, and that's a very good sign. I think people are calling for a big drop in the market. The market doesn't look like that. It doesn't look like that at all. So anyway, all the funds that we invest in are designed to capture different portions of the market, try to diversify, try to stay away as much as we can from those pockets that get super overpriced. That's not always that easy to do. And by the way, the ones that got super overpriced 2.5 years ago stayed super overpriced and got even higher the next 2.5 years. So for about 5 years, stuff that was overpriced just kept running. And it's the same thing that happened in the late 90s. And we've experienced a smaller, it's nowhere near the extent it was in the late 90s, but it did. And I've got to take a real quick call. By the way, if you'd like to call, the number is 216-901-0945, 216-901-0945, and I'm going right to Philip.
Well, good morning, Bill.
Good morning.
Got a question for you on a big picture idea about a change in consumer sentiment towards consumer staples like Kraft Heinz, like Coca-Cola,
Right.
things that have kind of been bellwethers. One theory I heard was some of the declines are basically because of the changes of younger generations not going towards the packaged foods, not going for the sugar water. What do you think on that as a going forward proposition that the road ahead of them is rougher than it used to be?
I think that you have to take a large number of polls, and by the time you gather all the information on the polls that you're going to need, it will have changed. The brand awareness is still a big deal, and whether or not that's going to be the only deal. If price is the only issue, which is oftentimes what people are talking about, not always, but if price is the only issue, there's always going to be cheap stuff. I've got these lights I bought off of Amazon, and I have to tell you, they looked like they were fairly high quality. I get them. They weren't even that much cheaper than the others. I mean, there was very little savings in there. I just thought they looked like a really good pair of lights, lighting for some stuff I'm doing around my marketing programs. I get them out, and those things are unbelievably cheap, and 2 of them have already broken. And I'm just going, wow. So I don't know. I think
Chinese prison labor isn't what it used to be.
Right, that's true. Yeah, and they moved a lot of it to Vietnam. So it's tough. Building a brand, it's tough. I mean, look at Apple. Apple's a brand. They make the same type of technology that everybody else makes. It is hard to stay. That's probably a really poor comparison because Apple's a technology stuck. But and I don't know. I think by the time people actually figure all that out, it'll have changed again. So I just try to go down and I'd like to look at the numbers of the companies that I'm interested in investing in and not worry about what I think somebody might buy in the future, because that is really hard to predict. I mean, that is incredibly difficult. And that's where everybody gets in trouble. They're always trying to predict things that you can't really predict for. And if you could, then you could be, an extremely successful investor. But
have you looked at Kraft Heinz at all? Because their major write-down was in goodwill of the value of the brand names as opposed to actual reduction in revenues.
Well, that's because
so
when you pay a whole lot more than book value for an asset, that's basically what you're buying. You're purchasing goodwill. And so they took an accelerated, and I'm not sure exactly what they did. I read some of the headlines. I'm not all that interested in it because it's, basically they didn't get bargain prices on Heinz or Kraft. That group down in South America that teamed up with Warren Buffett to buy Heinz, and then they merged Kraft together and thought they were going to cut their costs, and it was going to be a big deal. So they're saying, hey, this didn't work out like we thought it was. We're not making the gains or the price improvements we thought we were going to make. So let's write this down. Let's take some acceleration and take some of that off a little quicker. But that's basically what happened. And anytime a business pays more than the actual book value of a business, they carry that goodwill on. And I don't know exactly what the rules are for companies of that size to be able to go ahead and say, oh, you know what? Since we paid so much more than the asset value, we're just going to accelerate this and write this off. I have no idea. So,
well, I think it's kind of interesting. The same week they cut the dividend and take that charge, they also there's an announcement that their accounting practices are being investigated by the SEC.
Well, sure, yeah, because like I said, why wouldn't they have taken those write-downs earlier Why wouldn't they come right up front and say, hey, okay, this is what we're expecting. We're going to, it's really tough. Whenever you buy a company and you're paying for it, and you're paying a lot more than the basically the liquidation value is, it gets really complicated in a hurry. And if you're not doing as well as you thought you did, and if you're over leveraged, and I haven't looked at the balance sheet of that company, I really wasn't that interested in it. Neither one of those companies were super cheap anyway, even before they bought them out. And then the prices that they paid for them, I thought, they're not getting a bargain there. And Warren Buffett, I understood, he's big into brands. He likes buying brands. That's why he owns Dairy Queen. That's why he owns the underwear, Fruit of the Loom. He bought them out of bankruptcy because of the brands. And he's a really big believer in brand awareness. And I get it. And I think probably it's still very important, maybe not as important as it was before the internet, but I think it's still pretty important. And I just looked at the whole thing, and these guys just have too much money to invest, and they're going out after these deals that are mediocre to begin with. So, yeah, I guess I get a little upset if things didn't start working really quickly, if I didn't get the magic fix, and you didn't start gushing cash. But, I don't know what you can expect. And at those levels, when you've got that kind of money, there's really just not a whole lot of places to put it. I mean, realistically. You can't just create profitable companies to invest in because you have cash. The world doesn't work that way. So you have to take what you got. And those guys are kind of stuck with that. It's either that or they're going to buy a bunch of really small companies and have no way to effectively manage that. So I would love to have their problem of having billions to invest and not knowing what to do with it. That would be great. But anyway, so those are my thoughts. I think by the time you could gather all that information, man, it's all going to have changed. And brand awareness is still a big deal. You're getting brand awareness a lot differently than you used to, because before the internet, it was pretty much television, magazines, newspapers, radio, much more traditional. Now you got some kid out in California somewhere putting makeup on that's a multimillionaire by the time she's 18 years old. She built a brand when she was in high school. And that's amazing. You don't have to have nearly as much money, and getting your arms around all that would be incredibly difficult. Anyway, hey, Phil, I got to take a real quick commercial break. Did you want to hang on, or did you want to?
Nope, that's it. Thanks.
All right, thanks. Listen to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
All this pain, all this suffering. There's a
And we're back. You're listening to Bill Bullington right here on 1420 The Answer every Saturday morning from 11 to noon. You can go to my website, bullingtoncapital.com, if you want to know more about our firm. We offer a free Get Acquainted meeting. It can be done in the phone or in person. And I'm going to go right to the phones now with Victor. Victor, hey, you've been hanging in there patiently. Thank you very much.
Yeah, good morning, Bill.
How are you?
Okay. See, I was reading an article the other day on Market Watch, CBS Market Watch.
Yep.
And it was Warren Buffett. They were talking to him, and he essentially said, Warren Buffett being probably one of the greatest investors of all time, he said that his best hand-picked stock-picking talent has not achieved the essential goal of beating the S&P 500
recently
over the last 10 years.
Right.
And that was quite an admission from him, and he said going forward, he doesn't expect that to be the case either. Just wanted to get your thoughts on that.
Same thing that I was kind of alluding to earlier. When you get so big, those guys are actually too big for the stock market. It's incredibly difficult. There are only a little over 3,000 stocks that are big enough for an institution to invest in. Warren Buffett and his team have to pick from the biggest of the big stocks. So the companies in the S&P 500, the number anything below 250, they are relatively small. If he were to buy those, he would have to buy dozens of them to be able to increase the returns that he's going to get, because he's just so big and they're so small. Does that make sense?
Well, isn't that the case of a lot of these mutual funds today?
It is, and it's one of the reasons that the S&P's done so well. They've got nowhere other place to put the money. But that's their problem, and if you're a big investor, that's your problem. Is there's no other place to put the money. And for the past 5 years, I mean, the S&P's smoked nearly everybody because there's a lot of money. They've created so much more money than they have places to put it in the not just in America, but around the world. And so if you're a really patient investor and you were to go out and let's say you bought a companies that excluded the top 500, the S&P 500, essentially, like Russell did. Russell has a mid-cap index that's a 2,500 stocks below the top 500. And if you put some of the money in one that they buy based on valuation, they try to get rid of the overvalued ones, and then got another one that is more growth-oriented. You put those two together, and it's beaten the S&P 500 over the last 5, 10, and 15 years. The indexes have. The funds themselves have only been around for about 10 years. So, but you're not. I mean, you're going into companies there that are really small inside that fund. They're able to do it so far. If now that I mentioned it, if other people start repeating that and money goes into those funds, they're going to be forced out of that. So there are only so many places around the world to put your money anymore. And once you get really, really big, it's hard. I mean, it's really difficult to outperform a market cap weighted index. So,
yeah, okay, well, very good. I just wanted to bring that to your attention, and I was kind of surprised to hear that, saying that Buffett is kind of the guru of investing, and here he is making this pretty humble admission that he just going forward can't compete.
Well, can't compete because of his size, though. There's a big difference. There are a lot of if you were to stay in, say, a small mid cap, international emerging market, by the way, their longer term returns are better than the S&Ps. But over the last 5 to 10 years, nobody's wanted to invest in anything but the S&P. So, and that happened in the late 90s too. And it happened in the late 60s. There other time in 1972, the market peaked, dropped over 50%. The next 2 years, the Nasdaq dropped 70. Does that sound familiar? That cycle is something I try to shed some light on a lot, because it can convince you that you can't beat it. Well, I think you still can. It's just you're not going to beat it every year, and sometimes you'll go for 5 or 6 years and still get beat. But eventually, inevitably, Microsoft was a better buy when it was 40 million than it is when it's 400 billion. Would you agree?
Yeah.
Okay, so that's going to be in the small cap fund before it ever makes the S&P 500. So and the differences are probably somewhere around 100 basis points or so, which is 1% if you give it a super long time period. But those smaller funds can lag the bigger funds when the bigger funds are popular for years. And that's what's really frustrating about investing, man, because you're doing the right things, but you're not getting paid. And
the market doesn't make much sense anymore.
It never really has. I looked back at some early stuff back in the 30s and the 20s, and holy cow, you want to talk about crazy. It was like the late 90s, throughout that entire time period. Stocks rose and fell on rumors. Rarely did they go up and down on the actual business itself. But
Unbelievable. Okay, Bill, thanks very much. I appreciate it.
Hey, thanks for calling.
Bye-bye.
Bye. And I'm going to Gerry. You're on the lookout. I was going to say look out for the bull.
Good morning, Professor Bullington. I hope you're well.
I'm doing as good as I can be expected, I think.
All right. I have two questions, and I have a stock for you. First, we'll start with a stock, ABBV, ABBV. It is at its almost annual low. Paying a nice juicy 5% dividend, and I think it's got some. It's still got some gas in the tank. What do you think? Have you been following this?
No.
No.
Nope. ABV. I used to. Hang on a second. I have to pull up. Actually, I'll have to do that when I've got a commercial break, because it might take a minute to get that pulled up. But yeah, it's a pharmaceutical manufacturer. I mean, that part, it's been around for a long time.
Sure.
And which stock charts? By the way, if you'd have bought that stock, ABV. Let's see. Nope, that's not it. That's the wrong one. I was gonna say, yeah. Oh, it's got a market cap of about 118 billion, revenues about 32 billion, so it's not cheap. The revenue growth was 7%. That's pretty good, especially on a $32 billion. That's $2 billion. Looks like they did something that cost them money here lately, because their profit margin for the last quarter was minus 22%. You'd have to look into that. That's not all that significant. It's not the best case scenario, but you look at their gross profit margin of 75%. That's why that thing has such a huge price to sales ratio, is because their gross profit margins, 75%. That's pretty good. That's really good, actually. One of the higher ones. That's why it's got a high valuation too. Compared
to its pricing over the last year, it's down near the bottom.
Well, see, you're only talking about share price, which is meaningless.
Okay.
Share price means nothing.
Well, if you're looking for appreciation or return on dividend,
you have to know what the value is. The share price is meaningless. If they split that stock, if they split that stock 4 for 1, it'll be $20 a share, but you're going to have 4 shares. Is that any different?
Yeah.
You still have $80. It's the same. So you got to look at the numbers. There's 2 parts to every story. The first part is the story itself. Okay. The story is, what do they do? What do they make? How successful have they been in the past? The second part of the story is the numbers. And a good investment has good numbers and a good story. And that increases the odds. It's not a guarantee, but it increases the odds of a successful investment. So this one's actually been around for a long time. It's a good company, obviously. It's very profitable. Normally, I would go look into why they've had that charge against earnings. But me having done this for so long, the price to sales ratio is close to 4. That's the long-term average. Actually, theirs is 3.78, so it's slightly below its long-term average. If you wanted to buy something like this and hang on to it or write calls against it, I got no problem with that. But I just wouldn't put a large percentage of my money in there, because it's not a stock that's like super cheap. It's not super undervalued. If it were to go down to say 50, that would be awesome. Then I would say, what, this is a good one. And,
okay, that's fair. So you're saying it's not a bad stock. However, there are betters out there. There are better out there, and I can accept that. It looked to be somewhat attractive to me, but that's fine. I suppose it's your style of investing. All righty. Now, the next question I have, which is a trading strategy. Bill, as you know, there's a few of us that buy stocks and sell covered calls against them.
Right.
Now, in this scenario, say, for example, the buyer likes Home Depot. They purchase it at $180 and sell a covered call at, say, $185. Okay? Immediately, and make it a 3-month call, something that or shorter, so it's got a terminate point. Okay, at that point, the stock goes to 85 and then actually keeps going and hits, let's say 90. So it doesn't look good for the holder of the stock that they're going to be able to collect a premium and still hold on to the stock, you might say.
Right.
Okay. What would keep the investor from going out and looking at this saying, well, I have some loose cash on the sideline. I'm going to sell a put at, say, $180, say that follows it maybe by 2 or 3 weeks.
Now, the minute I do that, Gerry, not you, the minute I do that, the CEO is going to leave the country. And I just sold a put, right? Because I didn't want the stock call to, I wanted to get a little bit more juice out of it because I have a call that and it looks like the stock's going to be called away.
Precisely.
So if Bill Bullington did that, no doubt the CEO takes off, probably goes with Amazon's former ex-wife or whatever, that they'd leave the country together and they take a lot of Home Depot's money with them. The stock craters.
Of course, I understand.
Goes down to $100. So now the call premium, I get to keep the call premium, but I have the stock, and since I sold the put, I had to hang on to the stock, and I would lose. Bill Bullington would probably end up losing 5 times the amount of money he expected to make.
That's true. It's very true. There are risks involved in that, but
those risks are huge.
If you do it with a solid blue chip, it's not nearly as great as you would.
No.
Okay. Well, I'm just, as I said, just asking. I asked your opinion, so that's.
And all I have to do, I'm telling you, the minute I do it, it's going bad.
Okay, I can accept that. It's the conservative standpoint, certainly. I would not disagree. One other question I have here. Actually, I have two. Could you explain selling against the box? You don't hear that term very often anymore, but it.
Man, I haven't heard that for so long. I forgot what it is. I it's familiar. I'd have to go back because I did pass the options principles exam. So, which incidentally only 1 out of 1,000 people in my industry ever bothers to take that thing. But I forgot what it was, so I'd have to go look it up.
Okay, it has something to do with if you have appreciation in the stock that you would sell it short to keep that appreciation should it go down. And perhaps it's because options are available. It's been somewhat grandfathered out. Maybe that's why. I just, as I say, I remember the term, and I didn't understand it completely myself, but I think that may have something to do with it. Now that options are a lot more widespread, that would occur. Okay, last question I have is there's something called the bucket shops. Would you elucidate on those?
The bucket shops disappeared a long time ago. Actually, with the creation of the SEC, well, not the SEC. There were several different phrases. There's a lot about them written in the Reminiscence of a Stock Operator.
Jesse Livermore.
Yeah. And they called him something else in the book. He had a pseudonym because he was still trading at that point in time. But a bucket shop was a place that would take orders, and they basically would put them in a bucket. They would never actually even submit the orders to the New York or the American stock exchanges because they knew people were going to get wiped out on them. Back in those days, you were allowed to buy stock with only 2% down.
Oh, you're kidding.
Nope.
Good
so
Lord.
Here's what 2%? They would 2%. Yep. So
that's insane.
Yeah. So these guys would come in there. They buy.
Speculative.
They would say, okay, GE or RCA. That'd be a really good. RCA sell it for $300 a share.
Yeah.
And we want to buy 1 share of RCA, and we only need to put up $6. So they would show you, okay, it's just sold for $300. You're going to put up $6. You can buy that $300 stock.
Jeez.
Oh, hey, wait a minute! It just traded at $293.50.
Got a margin call.
Yeah. Not only did you lose your $6, you owe us about $1.50 on top of that, and you got to pay up because you're standing there right in the bucket shop looking at the quote boys write the quotes on the chalkboard.
Good Lord, that's astounding. I have never heard. I knew that was one of the reasons why the market took such a big hit rate.
Hey Gerry, can you hang on for a second? I got to take a real quick.
I'd like to.
Okay, yep. You're listening to Bill Bullington right here on 1420 The Answer. I'll be right back.
Have you heard of the one who can calm the raging sea?
Looking for a great way to save on taxes? Look no more. Just call Our Lady of the Wayside at 1-800-368-6262 and ask about their car donation program. It's simple and it works for everyone involved. You donate your ride, you write off the selling price, and the money goes to help the physically and mentally challenged citizens served by Our Lady of the Wayside. The number to call, 1-800-368-6262.
Well, you want more, so get more. Donate your ride to Our Lady of the Wayside.
Man, we're back. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. You can also find this on my website, bullingtoncapital.com, or go to the Fish's podcast, 955thefish.com. The show is carried there as a podcast. And I'm going to go right back to the phones. And Gerry, you still there?
Yes, sir. Yes, sir.
I was just...
Well, I was really left chuckling when you said that the not the margin requirements, the capital requirements are 2% prior to the start of the SEC, or
Oh yeah, and those guys used to stand around. They used to stand around in the bucket shop while the quote boys were changing the quotes on the chalkboard.
Sure.
And they were. It was like going to the horse races. They would go in there and bet. But when you got a 2% margin requirement and the market drops 4 or 5%, you now owe 2 to 3 times more than you bet.
Well, that obviously fueled the Great Depression, that type of nonsense.
Yeah, they were. I think the regular margin requirements were 10%, but if you were what today would have been called a day trader, your margin requirements were a lot lower.
Wow. Now, what was the 2%? That was trading on the big board, or was that at the bucket shops?
Well, you could trade just about anything there, because essentially what a lot of these bucket shops would do. So let's say you bought a stock at $100 a share, you only put $2 for it. A quote would come up saying that last traded at 97. Oops, you're out and you owe us another $1.
Yeah. Wow.
So a lot of the share prices, and they didn't even know. I mean, they're calling New York City. If it was traded on the New York Stock Exchange, yes, they would get the quotes directly from the New York Stock Exchange from a ticker tape, and they would write that up on the board. By the way, the ticker tape was invented way before the 30s and way before the Depression. So early,
I know Bennett did too.
Yeah, so they used that a lot to get the quotes, and those would be the last quotes on the stocks that were more actively traded, and it was just nuts. But you get companies. I think RCA. I was watching this show one time. I can't remember what it was on, but anyway, RCA stock just went crazy through the 1920s, because who in the heck wouldn't want to get a radio to listen to a live person's voice, coming through this magic box?
Right.
And so this stock goes up. It was in the $300 or $400 a share, something like that.
Wow.
And when it crashed, it took it until the late 1960s to recover.
Good Lord.
Eventually, and most of the companies didn't recover. That was one of the lucky ones, the company that managed to stay in business because they got into other businesses and produced a whole bunch of equipment for the radio, television, and also the phonographs and that kind of stuff. So they struggled, they survived, and it only took them, 50 years to get for people to break even.
Yeah, a lifetime.
Yeah.
A lifetime. That's amazing. Well, it's the old adage that there are a number of reasons that the economy ever recovered. Some attribute it to FDR, of course, and his New Deal. Others say it took the Second World War.
It was both.
An opinion?
They all contributed.
That's what I was just going to say. That probably FDR was not nearly as grand as some of the intellectuals were stating, but he certainly got things going the right way. From what they say, in his day, he was making the world safe for capitalism again, or reinventing capitalism so it could survive.
Every president reminds me of a quarterback on an NFL team.
Mm-hmm.
They're only as good as the offensive line
Yeah, very, very true.
And ask a former Cleveland Browns quarterback up until recently. And the receivers have got to be good too. So the quarterbacks get way too much credit, and they take way too much blame.
That's very true. I agree with that statement.
Yeah, so it's interesting, and there's like Keynesian economics got really strong back then because he was saying if governments spend money, and then of course World War II just happens to come out. Actually, I think he was writing a part of that during the beginning of the wars, and so government steps in to spend and cut taxes when economy is doing poorly. When the economy starts to do well, then the government can make some of the money back that it spent. So you have to raise taxes, and then you reduce government spending, and it's kind of a balancing act. And then Friedman came along later, and a lot of people back when I was in college studying economics, they had these guys as diametrically opposed to one another. Friedman was saying, it's the money supply, the money supply. Well, no, actually, that just told you how to finance what Keynes said you should be doing. They're actually symbiotic. They work together, and we've got it down now. It works pretty good. Are you going to avoid problems? Nope, because some problems are just unavoidable. You won't even know you have a problem until it's too late, and then you have to take corrective action. And it's the speed and how much effort you put into that corrective action that'll determine how quickly you recover. This last recovery, this recession could have been way worse. The recovery was one of the slowest in history because there was a lot of reasons for that. But they did take a lot of really bold steps that stopped it in its tracks. It could have been another, 1930s type scenario again if we hadn't have taken the actions that we did and had the experience through all the other recessions that we've learned from over the decades.
Now, who would you attribute that to? The
Bernanke?
Fed, yeah. I was going to say, rather than a political situation. Right. But Bernanke certainly did a world of good when we were really facing some serious troubles.
Oh, I think he did his PhD thesis on the Depression. So he studied. He knew quite well. He was the right guy at the right time. We lucked out, quite frankly. We just got lucky.
I agree with that entirely. Do you feel that any of the politicians in Washington are actually taking this new Green Deal or whatever AOC calls it? Do you think they're taking it seriously?
I think some are. I think.
Do you really?
In America, I think you can make a statement as plain or as outlandish as you want, and you'll find people that'll agree with both of them.
It just seems that any sane person would say it's impossible to rebuild the entire infrastructure, all the buildings in the country, and all that. I don't even see how the economists can even put a price tag on it. It's so ludicrous, in my opinion.
And by the time they gathered all that information, it will have changed.
Of course, but it would be, give or take 50% of that would be significant. It's just so monumental. It dwarfs the Marshall Plan in post World War II.
Yeah. Oh yeah.
It absolutely dwarfs it.
Yep. And we were doing the Marshall Plan at the same time they started building the national highway system.
Yes, it's true. So okay, I was curious. I just find it so thoroughly outlandish that it's beyond comprehension. But
I wonder if the techniques now, I don't know, maybe Trump has started a trend here because it was so successful for him. You ask for things you absolutely positively are not going to get because you might get more than you planned on getting to begin with anyway. And that's a negotiation technique. And, Trump's been really good at it. I mean, he's actually done a lot of stuff that way. So maybe they're just trying to take a page from his playbook.
All righty. I'll let you get going, William. Have a great week.
Thanks.
And as I say, happy trading.
All right. Thanks.
Yeah. Bye-bye.
And if you heard anything here, we kind of talks a lot about things not all that didn't have a lot to do with retirement planning or not running out of money during retirement, because I did have a couple of topics there I wanted to talk about, but I'll get to it next week. And you can always call And I'm kind of fascinated by that too. People talk a lot about this. There's magic numbers. What do I take out of my money? How much money do I need? And the bottom line is, a lot of it's pretty common sense. But everybody's situation is just a little bit different. I've never met two people who had the identical financial situation. And if I did, I've never met two people that were fairly close to each other financially who had the same opinions. So a lot of this, your financial plan, a big part of it are your opinions. Maybe you've got really nice kids and you want to leave a legacy for them, so you want to be more careful with how you're spending in retirement. Maybe not so much, or maybe you don't have any kids. You don't have any kids at all, so that's not a big concern. You've got different risk tolerances, and I am going to leave though. We've got a couple minutes left with this. So I'm trying to put this little video together on how to determine what kind of risk taker you are. I've seen tons of questionnaires. I see them all the time. Nobody likes those things, by the way, me included. I don't think they do a really good job of explaining the kind of risk that you're about to take after you answer those questions. And I think a lot of people just get, quite frankly, they're just confused. So here's a thought. Stock market was down. The S&P was down. The average stocks are down 50% a year, by the way, or their range is 50%, not down 50%, but the range is 50% a year. So S&P was down 50% in March of 2000 through March of 2003. And then from November of 2007 to March of 2009, it was down 50% again. So you got to figure, if it can happen twice in 10 years, it may happen again. And now that I hear the music, I'm actually going to have to finish that thought next week. Sorry about that. You've been listening to Bill Bullington. I'll see you next weekend.
Broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.